Okay, next question. Very good question. What percentage of my crypto portfolio should I hold in Bitcoin? Okay, once again, as usual, this is not financial advice. We're not investment advisors. We're not your investment advisor. All we can do is just share our research and how we would think for us, but definitely consult a professional when you're building your own investment portfolio. So if we go to tokenmetrics.com, and my strategy, if I had to build a portfolio, this is the reasoning I would use. This is for me, not for you, but this is how I would think. So maybe you guys could learn from that. So we would say we need to have more than 10 cryptocurrencies in our portfolio. Now, the reason I say, for me, if I'm building a portfolio, where I would say 10, is you need to have a diversified portfolio. And based on the research on modern portfolio theory, having more than 10 diversifies your portfolio. And then when you add different cryptocurrencies into your portfolio, you need to make sure that there are cryptocurrencies that are not correlated. What does that mean? Correlation means that when something follows something by a particular percentage. So for example, if we look into Bitcoin, one of the good things that I like about Token Metrics is we have a tab in here that shows you what other cryptocurrencies correlate with that particular cryptocurrency. So in this example, we're looking at Bitcoin. So this tells us ZB, Link, which is Chainlink, TR, KCS, which is KuCoin, and HT, which is Huobi, I believe, are the top 5 cryptocurrencies that correlate with Bitcoin, meaning that when Bitcoin goes up, they also go up. So correlation is measured from -1 to +1. +1 means it's highly correlated. -1 means it's inversely correlated, meaning it goes the opposite. So positive correlation with Bitcoin means that when Bitcoin goes up, they go up a similar percentage. So for example, don't quote me on this, but I believe if something is like, for example, HT, Huobi, has 89 correlation, meaning that for every one time Bitcoin goes up, like 89% of the time, it also goes up, something like that. Then negative correlation is the opposite. So let's say you think Bitcoin is going to go down. Then as a shrewd investor, thanks to Token Metrics, you can say, okay, I want something that will go against the trend, something that's not going to follow Bitcoin. So in this example, you would look for cryptocurrencies that have the opposite correlation with Bitcoin, that don't follow Bitcoin. So meaning that if Bitcoin is going down, you want something that's going to go up when Bitcoin goes down. So looking at this says EDR, TCT, B2G, HDAC, Waves. So these have the most negative correlation. So they don't follow Bitcoin at all. So when we're building a portfolio and we have more than 10 cryptocurrencies, we want most of them to not have any correlation with each other. So you want a portfolio that has no correlation. So I believe in modern portfolio theory, you want a portfolio that has a correlation that adds up to 0, meaning that you probably, when you add up the correlations for all the 10 cryptocurrencies, you want it to be neutral. I believe. Don't quote me on that, because I'm doing this off the top of my head. But this is what I was learning in my Series 65 exam to become an investment advisor exam. But anyway, so you want a portfolio with different assets that are not correlated. So that's the rule number 2. So rule 1, you want to have lots of cryptocurrencies. So having just one does not diversify you from a risk, because there's lots of other risks involved. Not just risk of losing your investment, but you have market risk, you have currency risk. So there's lots of other risks involved in investing that you have to factor all those in. So imagine, let's say you pick a good investment, but the whole market goes down. Market risk. Or let's say you pick a good investment, but when you convert from Bitcoin to the dollar goes up in value because the economy is doing well. That's a risk you have to account for. So there's even political risk, legal risk. I mean, right? Let's say the government come and just shut exchanges down. And Bitcoin was doing well, but If they do that, it's going to mess up everything. So lots of risks you have to factor in. So it helps to have a diversified portfolio and to have a portfolio with correlations with assets that don't correlate with each other. So going back to the market here, so we pull this up. So if I had to pick 10 cryptocurrencies, I would go to tokenmetrics.com, sort by grade, and I would pick the top 10 at this point in time. So my portfolio would include 1, Bitcoin, 2, Ethereum. Actually, let me zoom in here. So Bitcoin, Ethereum, Dash, Zcash, Binance, 0x, Neo, Maker, Cosmos, and Holochain. I would have minimum those top 10. And now, actually, sorry, not quite like this. This is just kind of me making things simple, but you start with this initial top 10, and then we would see the correlation of the portfolio. If, for example, if 4 of these coins correlate with Bitcoin, then maybe we should not put them in our portfolio because we get the equivalence by just investing in Bitcoin. Or maybe let's say for some reason Zcash correlates with Bitcoin, but Zcash has room for more growth, then maybe we should not own as much Bitcoin because we can get a better return with Zcash. These are the different things you have to kind of think about when you're building a portfolio. But to keep it simple, let's just assume that all these 10 don't correlate with each other. So we take those 10, and now we have to figure out the proper weights in our portfolio. Do we want to have 10% of each, or do we want to have 50% of Bitcoin and the rest? That's the $1 million question now. So for us, what we're trying to build is to let machine learning figure this out for us, because machine learning computers, AI, can run thousands, hundreds of thousands, millions of simulations to find out what is the best portfolio allocation. Should we have 60% Bitcoin or 10% Bitcoin? Should we have 20% Ethereum or 30% Ethereum? So all these different things, we think this can be best done using simulation and machine learning. So that's something we've not built that yet. It's going to take a while. Right now, we just built a platform, but that's the vision we have of where we're trying to take Token Metrics, because we want to automate this for users so that they don't have to think about this. But all I can say now is I would just do it based on in this order and based on the grade. So for example, Bitcoin should have the highest weight in your portfolio, followed by Ethereum, then Dash, then so on, until you reach Holochain. Meaning Holochain would have a lot less than Bitcoin. And that's really how we would go about it. Now, the weights is something that would take a long time, so not really going to get into that, but hopefully that answers your question. I know it did not get into everything, but I think it should answer most of the question. So what percentage of your portfolio should hold Bitcoin? Bitcoin should be the most in your portfolio. Whether that's 50% or more, it depends, but Bitcoin should be the most in your portfolio. That's all I can say for now.